Good afternoon. This is Jim Barlow with OakTree Strategic Leverage. I'm in Oban Beach. I think I'm saying that right, just north of Daytona Beach. Last week we're in Orlando, and this week we're on a pretty beach property. Watched a couple beautiful sunsets yesterday and this morning, and I'll do it again the next few days. Anyway, let's talk about retirement. Is there a better way, a transformative approach to retiring? Well, there is. I'm going to show you the Inversion Wealth Framework, a framework I developed that will help, I believe, most people. Now, a little bit about me. Lifelong resident of Clearfield, Utah, married to Barbara. We have 7 children. We have 28 grandchildren. I have 1 great-great-grandchild, son, coming in June probably. BYU graduate, devoted fan. I love BYU. Investment advisor for 35 years plus. Our passions, family is everything. We love to travel. Like you can see, we're in Florida today. We serve in the temple. The reason I have my business, I believe in doing good, helping others. So why OakTree? I didn't retire from purpose. I built OakTree because I believe there's a better way to protect more, keep more, and do more. With what you built, time may have changed my role, but it doesn't take away my calling. I'm still striving, still seeking, still helping others find a better way. So, is there a better way? Well, you can win without losing. The reality of retirement changes everything. You're no longer contributing. You're now withdrawing. Timing matters more than ever. You know, when you're contributing, it really didn't matter if the market was down and you're putting more money in, you're buying at lows. The rules have changed for retirement. The rules change for everyone's retirement. But most plans, most strategies don't. Markets don't matter as much as when you're saving. They matter a lot when you're spending. The retirement danger zone, the first 5 to 10 years matter the most. It can be the most devastating. Withdrawals begin, market volatility hits harder because of withdrawals at bad times. Mistakes become permanent. This is where most plans fail. How people actually lose in retirement. Well, it's not bad returns, it's bad timing. Sequence risk is horrendously bad. Just a quick example, let's say you have $2 million and you're going to pull out 5% a year, 100,000. But if you're in the market, let's say you have a market that goes down 2008, 40%. And then you take money out after it's gone down. You'd never recover from that. Your 5% from that 2, you're going to have to rethink. Forced withdrawals during downturns. Emotional decisions under pressure. Loss of income control. Tax inefficient. Require minimum distributions. Have to pay taxes. The wrong question. Most people ask, what return do I need? A better question, what could permanently damage my retirement? The insight. In retirement, avoiding loss matters more than achieving gain. The shift from growth strategy to an income structure, not just building wealth, but protecting distribution. You don't rise and fall with the markets. You live off them. Inversion thinking. I'm not going to give a lot of detail about inversion thinking in this retirement presentation. In the generic one I do, but not this one, but I do want to say inversion thinking is a way of solving problems backwards. Instead of asking, how do I succeed in retirement? You ask, what could cause my retirement plan to fail? Then you eliminate those risks. Get rid of them. Because in retirement, it's not the average return that determines success. It's whether the plan survives. The Inversion Wealth Framework. This is the framework I developed. There's really 4 levels of this pyramid. First is inversion, deciding where things could break and put in a system, a structure that will avoid that ruin. That's the second step. Build a structure. Don't just buy a stock or something, but a structure that has some safety with the inversion system in mind. System design. Then when you have those 2 in place, you could actually leverage this, multiply it, and then have a little patience. No matter how, investors always have to have patience. That's my 4 steps. Let's go over these in a little bit more detail. Avoid ruin first. Identify what destroys wealth. Eliminate irreversible risk. Expose hidden vulnerabilities. There have been investments in my career that said, wow, I can't see how this could go down. I can't see how this could lose. And I know one that did. You got to make sure you know the structure. Win by not losing. The second layer, build what cannot break. This is fulfilling the inversion theory. Protect against sequence risk. Maintain control of timing. Design for stress. You don't have to be perfect, but you have to design for these things. Structure's the edge. Performance is the outcome. Third is the leverage. Amplify only after protection. Use institutional capital. We use about 3 to 1. Avoid personal guarantees. Align borrowing with the design. Leverage is powerful when it's controlled. Fourth, patience. Let time do the heavy lifting. Allow compounding to work. Avoid emotional decisions. Stay committed to the structure. Only what survives can compound. Now the framework, just reframed, applied to retirement. Inversion. Avoid income disruption. Structure. Protect timing and liquidity. Leverage, create more income from the same assets. Patience, sustain income over time. We'll show you. Most plans are built for accumulation, not retirement. We build plans to grow, not build plans to distribute. We don't build plans for stress. That's the missing piece. It's a different ball game, a different approach, designed for income stability, market volatility, long-term distribution, a structure from the moment most plans break. Retirement success isn't about earning more, it's about losing less at the wrong time. So if we know what destroys retirement income, and we know what a strong retirement structure requires, is there a system designed to solve for all of this, protect income from market loss, create tax-efficient income streams, use leverage without risky retirement security, provide reliable, accessible liquidity? Or are we left hoping our plan holds when income matters most? Well, I found a company that built a product. NIW, they're a company out of Plano, Texas. Been down there a number of times. I know the people very well. They built a product. They gave it the name Kaizen. Kaizen is a Japanese word. I put the meaning down below. Continuous improvement. It's kind of a fun term. Continuous improvement. That's a theme for life. Continually improve. Their buzz line for Kaizen is more money, more protection, and more confidence. Let's show you. It's a transformational structure built on an index universal life policy that eliminates downside risk. No downside risk. Use institutional leverage, create tax-efficient income. That's the compliant way to say it's going to be tax-free. Defines a clear exit strategy. It's very turnkey. Not much to it, really. Well, I guess there is. Here's a simple version of what it is. You contribute for 5 years. The bank contributes additional capital alongside you for that 5 years. Then the bank continues funding for the next 5 years. The policy grows with built-in protection, and then we repay the loan around the 15th year. From that point on forward, the structure is fully yours, unencumbered, income ready, tax-free. Why it fits the structure, the framework. Inversion, downside protection. No negative years. Structure defined system, no market guessing. Leverage about 3-to-1 institutional capital, and has the long-term compounding available. Today we're talking about retirement, but Kaizen can be used for other purposes. These are the top 6. There's other reasons. Family gifting is another big one. Executive employee retention, another big one. Business succession planning, creditor protection. You get that in all cases. Or just tax efficient income. Who's this for? It's not for everybody. I'm sorry. Best fit for high income earners, business owners, professionals, families thinking generationally. Who qualifies? Typically 18 to 65. In fact, I probably need to change that for typically. 18 to 65. They won't sell it to anyone over 65. health, in good health, have to be insurable, and pretty good health. Income, approximately 200,000 plus. One of our vendors, we could go down to 100,000, but generally speaking, that'd be what the income is necessary. Then you need to have the plan funding. The minimums, depending on age, 22 to 32,000 a year. You can put as much as you want above that, but that's kind of the minimums. And then the commitment. There's 10 years of payments, 5 by you, 10 for the bank, and at 15 years is our target to pay off the bank. So that's the commitment, some time. Now in the next few slides, I'm going to try in a short period of time to tell you all the main features of Kaizen. I put them into 4 categories: the foundation, the growth, the control, and the leverage. The foundation. It is built on a life insurance chassis. So you have death benefit, transfer wealth efficiently, and you also have living benefits, protection when life doesn't go as planned. I'm going to skip ahead and then come back. Here's some of the living benefits. You can have critical illness, lump sum, not just your cash value, but on the death benefit for major health events. Critical injury, accidents, supports for severe injuries. Chronic illness, access funds for long-term care. Terminal illness, access to the death benefit again, or even cognitive impairment, covers for Alzheimer's and memory care. Everyone should have all these things covered to protect you and your family. You get those in Kaizen. Now let me go back. So you have the death benefit, you'll have the living benefits, then it's tax-free. When the insurance owner passes away, the proceeds go to the heirs tax-free. There are no taxes on the growth ever. And if you're the owner, you don't have to die to get access. You can borrow from this fund tax-free. That's how we give people a tax-free retirement. I'm going to show you a case study. I'll give you some numbers in a minute. Efficiencies. There's no ongoing advisory fee on life insurance or management fee. There is life insurance fees, but you have other fees that are non-existent. So that helps. This is the foundation, those 4 bullet points. The growth part. This is the inversion theory. 0 downside floor. If we have negative years in the market, you have a negative year, you'll get a 0. You'd never have a negative number. It's protected at 0. And you get market-linked growth. I'm going to show you how that kind of works in a second. And because you never have a down year, when the market turns, you don't have to recover. You have continuous compounding from the lower, a higher level to have you a better return. Let me show you 2 important things. How indexing works in an index universal life policy. Most of the premium is allocated to high-grade bonds, the protection part. with a smaller portion used for index options growth. Here's an example. Let's say you have beyond the insurance cost, you have $1,000 going into the cash value. They'll put about $950, 5% type market, into the bonds. And that will grow back to $1,000 in about a year. That's how you can't have a negative year because you're on every anniversary, you can't lose. Then the other piece of money they put into options linked to indexes that you choose. One is protection first, protection, then growth is second. That sequencing is what makes a structure transformative. I've used National Life and two of their options as a comparison. First one let's talk about is the Standard & Poor's 500 index. It's one of the things you can put money into. You get, remember, it has 0 negative years, but you're capped. The cap depends on the interest rate environment. The 11% is now. That's what the caps are, meaning if you get a return of 1 year at the market does 10%, you get 100% of that. If it does 12, you just get 11. If it does negative 20, you get 0. And here's the averages for the 5, 10, and 15 years. Some of my clients like that approach, the cap. Another approach is volatility controlled indexes. And one that National uses is called US Pacesetter. And because it's a more conservative index, we have 0 cap. You get whatever it grows to. And because it's a conservative approach, you don't get 100% of the growth. Right now it's 260%. So here's the performance based on the 260% for the last 5, 10, 15 years. You can see that this more conservative approach can actually give you higher returns than the Standard & Poor's 500. Not always, not every year, but historically it has. That shows you how come it's a 0 floor and you get market linked performance. Let me see. Let me cover everything. Okay, we covered all that. So that's the growth. Then we're going to jump ahead here to the control. NIW worked with insurance companies to build a structure the way they wanted it. First, protected ownership. We set up a trust in your name. It's your trust. And then we have a master trust. The master trust is the one who's doing the borrowing in your behalf and for your trust, getting the leverage. And because of the trust is actually, they use a company called Provident Life out of Las Vegas, Nevada, and Nevada has great creditor protection laws. You're protected against creditors because of this structure. Finite funding, 5 years of contributions. That is it. You don't pay more than 5 years. All else lets you do it in monthly payments for 5 years. National is an annual payment. They put a lot of riders on to protect and control the structure, designed to reinforce control and protect the structure. Then you have, after those 15 years, You have access to cash value with no taxes, no required minimum distribution, no forced withdrawals. In your retirement, you've got ultimate flexibility. And then turnkey design. Minimal management. You can change your allocation on your anniversary every year. You don't have to be a day trader. You can probably leave it the same place for the whole time. Very turnkey. That's the control part. Then we have the leverage. Institutional leverage, as I said, this master trust does the borrowing, approximately 3-to-1. More capital. It starts from when you put money in the first day, the bank's putting in money too, working from the first day with non-recourse structure. There's no personal guarantees or outside collateral. That gives you accelerated outcomes. Reach your objectives sooner. This is an efficient capital use. You can leave, not put as much money into the strategy because you can leave it where you want in stocks or whatever, or your business. Just put a smaller portion. Let me show you how this 5 years works. I've used silver pigs and gold pigs. The silver pigs is your contribution, 5 years. The bank is putting in approximately the same amount for the first 5 years. After 5 years, you're done. Absolutely. Then the bank continues to make the contribution they're making in the first 5 years. And then they start making the contribution you were making. And it comes out to be about 3-to-1 with no collateral, no guarantees. Pretty simple, really. No personal guarantees, no outside collateral, no traditional loan process, institutional underwriting built into the structure. This isn't about eliminating risk, it's about structuring it so it can't break. Yes, there is life insurance costs. And I wish, as an investment guy, I wish I could tell you it's 1% or something, or 1.5%, or whatever it is. But it's determined by death benefit, the age, and the health. So it ranges. Why don't we have to sell over 65, age 65? Because the cost becomes not possible for it to work the way we want. See, the cost varies. You know, the real question is there a cost? You knew there was. The question is, does this structure create more value than it consumes? What the structure enables: downside protection, tax advantage income, death benefit, leverage, liquidity. The goal is a structure that produces a superior outcome. We have NIW, my partners, have a software. The name of it's in the upper left corner, ILIA, Interactive Learning Information Assistant. Pretty interesting name. I use this software almost daily, all the time. It has a lot of information about Kaizen. You can read about it, read questions, whatever, but it also has an estimate my benefits. And you can have access to this site. And this is the site that I'm going to calculate an illustration for you. So the person I'm going to do a hypothetical on is a male age 46, excellent health, and he's willing to put in $70,000 annually for 5 years. He wants a distribution starting at age 65. He wants to make sure it happens and goes through 90. I'm going to use an illustration rate, which is the allowed illustration rate for right now of 6.81. We've averaged higher than that, but that's a conservative illustration rate. I'm going to show income taxes at 37%, capital gain rate at 70%. How come I picked a 46-year-old at $70,000 a year? The average investor in Kaizen is 46, and the average contribution of all put in is 70,000. The largest amount I was involved with was putting in $1 million per year, but 70,000 is the average. Let's show you the numbers. So these are what I'm going to produce for you. I'm going to give you some after-tax comparison. If we got the 6.81 in a regular investment, pay taxes as we went, I'm going to compare it with a tax-deferred investment, 401k, IRA, and Kaizen. I'm going to show you how much income the strategy will pay to begin with every year. And it's going to show you how much you've total pulled out by age of 90. I'm going to show you the death benefit at age 46 and the death benefit remaining at 90. So here we go. Let's get started. The after-tax investment can give you $58,642 per year. That is right on the button because we projected 6.81% for all the growth years and the distribution years. And I used every penny in this account to give that highest income. The income at 91 would be zero. I've used everything. So that's the after tax. Then we have the tax deferred IRA and 401ks. And it's more based on income taxes as they are today, not showing an increased tax or a lower, 74,106, or pulled out a total of 1,926,000. That's an improvement. That's good. That's quite a bit of improvement. What have we got? 16,000? That's a lot. So then we're going to go with Kaizen. My question is, a drum roll, please. Is it going to be more than 74? I guess you know in this presentation that it is. 84? 94? What is it? Well, drum roll, please. 130,000 approximately, with more money still there. And by age 90, we pulled out 3,380,000, 130,000. Did it recover all of the insurance costs? Absolutely. You got, in a sense, because you stayed with it, free insurance, free long-term care, free disability insurance. And at age, you had $2 million insurance at 46, you still have $1,702,000. And if we projected an income through 100, I think, well, I probably should put a line in this. It'd still be 130 through 100, not the other two. They're done. So, does it work? It does. A lot of people right there says, this looks too good to be true. I understand. No down years, tax-free returns, indexes at 260% sometimes is a cool strategy. And it does this exact for production. Now, we wanted to stress test Kaizen in the two worst case environments we know. First was the 1980s high rate environment. Loan rates came up to 16.88%. We simulated an environment using this highest interest rate to see how Kaizen did in this era. We also went through the Great Depression, 1930 to 32, the worst sequence of returns in US history. In this stress test, we projected 9 years out of 12 at zero return. Notice, no negative years, but 9 years of zero. Does it still work with 9 years of zero? Well, let's show you. The stress test of the 1980s, 97,500. Better than the 74, better than the 58, not the 130, sorry. But stress test for the 1980 looks good. Oh, those other two would have been lower too. Using the same percentage decrease, the after-tax would have been 43. The tax deferred would have been 55,000. So the 97 looks pretty nice if we had the 1980s. Well, how about the Great Depression? It's a little worse. 84,000. 84,000, still 10,000 over the tax deferred. And, you know, those numbers would have been lower too, 38 and 48, using the same percent of downturn. Wow. So we have 130. It overcame all the insurance costs and gave benefits. It was stress tests in bad times. Well, you know, I've got another drum roll, please. Allianz, it's the world's largest insurance company, one of the companies we do Kaizen with. They looked at this, they wanted to look at this ILIA illustration system and really give it the works and make sure it was accurate and that we weren't pulling any fast ones. They came back and said, we think there's an 80% chance that 130,000 isn't going to be 130. They said they think that 130 has an 80% chance of being double. 260,000, an 80% chance. Now our total income through 90 is 6,760,000, and I don't even have the numbers for the insurance part because it's 80% chance being double. So we have a range, 260,000 or that 70,000 for 5 years, or the average, the 6.81%, 130,000, or the stress test of the 80s or the Great Depression. This is a system that protects retirement. What if this 46-year-old male just had average health, not excellent health? Well, here's the numbers. Instead of 130,000, it'd be 120,000. Well, lower, but still better than the other two, and still okay in the stress test, and still really cool in the double. Average health still works. What if it's a female? Same age, 70,000. Well, females are more insurable. Instead of 130,000, it's 133,000. So the numbers got a little bit better. Not a lot, but a little bit. So average health or excellent health both works nicely. Need to be insurable. Now, I'm going to go back a little bit of history. The very first policy issued of Kaizen was 2012. One of the owners of NIW purchased it on June 27th, was it whatever that, you could subdue the, what, 13 years? 13 years ago, the first policy was issued, and she gets a statement every June. This is the last statement. She's averaged 7.85%. Not bad. And she's averaged paying interest on the borrowed money of 3.95. Then we calculate something we call the spread. We take the return, 7.85, subtract 3.95. On the borrowed money, she has made 3.9%. On the 3/4, 3-to-1, the borrowed money. This is what makes this thing hum and work so well, making a return on the borrowed money. They did another stress test. They did another test going back to 1930. They could not find a 15-year period of time where the spread was less than 2%. So the spread could be as low as 2. That's the lowest they've ever found. Or it could be 3.9 or maybe higher in the future. But you're going to make money on other people's money, the borrowed money. Now, long-term historical SP 500 return, about 10%. Well, Jim, 7.85 is not 10%. Yeah, but remember, that one's tax advantaged. That is tax-free. The 10% we've got to pay taxes on. And if we just do a 25% tax total, that makes it 7.5. Competitive with no downside. That's the actual first policy. The Kaizen principle. Most people focus on outcomes. Wise people focus on how the system is structured, because results rarely fail from lack of effort. They fail from poor design. Inversion teaches us to ask a better question, not what results do I want, but what structure produces that results consistently. Because success is not an event, it's a system. Structure first, results second. Transformation follows the structure. I have some ways for you to learn. This is the landing page. There's videos, there's 10 chapters. You can learn everything you want to learn, all on your own, on your computer, with this landing site. And there's a QR code to go to it. You don't have to have a login. You don't have to have a password. No one will know you're at the site. It's all on your own in your free time. This is a great site. When I started with using Kaizen, this wasn't available. It is now. Doing it, it's a wonderful site. The second way, we have another one just very similar to that, but this is for gifting. This is for those people who are gifting to their children or their grandchildren, a special use of Kaizen. And there's the QR code for that. Third is the Ilia site that I showed you. This one here, you do have to have a login and a password. You can request one from me, email, text me, and I need your birthday and your name, and your email and your cell phone number. I don't need your social security number. We're not buying today. And then I can give you access with a access code and a password. This was the original site. There's also my website. I have a great web designer. He does everything I like. This is the home page. It's pretty robust. I've got a bunch of links on it. You can look up on different things. I've got a retirement income gap calculator, a basic and advanced. The basic one, you could crunch through this without grabbing some papers. You know your numbers a little bit, and you'd have quickly know your income gap for retirement. Very simple. The more advanced as it puts in Social Security, puts in everything. This is pretty simple, but a good place to start. These are free. They're just on my site, just usable. You don't have to have a password to get into them. It's there. So how do you want to get involved and get engaged? One, I call it the Kaizen Online, the advisor back. This is where you go to those first two sites and learn on your own pace, digital engagement. When you have a question, I'm available. The Kaizen Online advisor backed. Or I'm old school guy. One-on-one, I can take you to lunch, take you to dinner, go over everything you ever wanted to know. Been in the business a long time. They're both the same strategy. It's Kaizen, just a different engagement style. Whatever path fits how you think and decide. I sometimes call the Amazon method. The service after you own it. There's actually three big areas. There's myself giving guidance. There's the program oversight by NIW. They are the ones that's sending these statements out for every year. And I told you very turnkey. There's not a lot of moving parts, but they're the oversight. Then we have the institutional partners. We have the insurance company. We have the commercial lender. We have the trust company. All these entities going together for this thing to work for you. So even if I'm no longer involved or around or whatever, it's going to work. I used to present this a few months ago, and I took it out and I put it back in today. The Kaizen Swiss Army knife, a complete financial tool set. Structure before strategy. Let me show you. Protection. Life insurance, living benefits, no loss, sequence protection, behavioral protection, creditor protection. Wow. Growth, compounding, acceleration, efficiency, control liquidity, control 5 payments, riders, turnkey, leverage, 3-to-1, non-recourse, capital efficient, tax and transfer, tax-free, tax diversification, no required minimum distribution rules, estate efficient. I can't even show you all the tools of that. All the knives of that. I can't show them all to you because it'd be too messy. That's all the things that Kaizen does. Win without losing. Structure's the edge. Performance is the outcome. What clients tell me matters most to them? They like the zero downside. That's probably number 1. 2, tax-free. Woo. Finite funding. 3, 5 years, 5 payments or 5 payments for 5 years. Death benefit and living benefits if things don't go quite right. Flexible liquidity. None of these are about chasing higher returns. They're about removing risk, increasing control, creating certainty. So I color coded. These are the ones that most clients point out they're most important to you. You know, and I looked over the list and said, wow, these are the ones that I think are also pretty darn good. Growth, leverage, non-recourse, no required minimum distribution, sequence protection, behavioral protection, creditor protection, turnkey. So I think there's a lot of features that this really has. So after 35 years in this business, I've learned to separate products from structures. Most financial tools are products. A few are structures. When someone has the runway, the time, and the health to qualify, I've yet to see a more efficient long-term structure than Kaizen. Is there a better way webinars? I got 5 webinars. Today's the second one. Last week was the flagship, the wealth building with Kaizen. Next week on Tuesday is the family gifting. I think the bi-monthly, I think the next one is the succession after that. I don't think I put it on the calendar. Here's this calendar. Next Tuesday is the family gifting. There's the code. You could take a screenshot and you could log into the webinar with that code. The 20th, oh, there we go. Business succession. I thought that was the case. Then May 26th, we're back to the flagship. A little more detail on Kaizen. So that's it for today. There is a better way. The Inversion Wealth Strat framework that I've built, and also Kaizen, what fits into it like a glove. Thank you for attending. And as you have questions, there's my phone number. You can email me. You can go to my website. There's those 2 sites. You can scan those. And thanks for attending. And maybe we'll see you next week. Have a great afternoon. I'm going to go. It's Cinco de Mayo. We're going to go out to eat at some cool Mexican place. Have a great day. Bye.